Hi, everyone. Welcome to the Victor H live stream. It is the middle of the week. It is May 29th. The market has closed, and I just wanted to do a midweek review of the stock market and see how things played out this week. We had, I think, a pretty severe down day today where we had stock prices really come down. The Dow especially went down more than 1%. The S&P went down 70.74%. The Nasdaq was down 0.58. Then the Russell was down 1.48, which the Russell represents the small caps, mid cap companies. Overall, the VIX, which is the volatility index, really went up. So I think that's where we're seeing more volatility. On a couple of stocks that I wanted to cover later today, Hewlett Packard announced after the bell. So I thought what would be a fun exercise would be to take a look at Hewlett Packard's financials, see how they did, and then update my analysis and my evaluation of the stock. So I can take that on a little later. All right. So, and just to kind of introduce it, there was a question on the live stream before I started, which was from Earthbound Misfit. Hello, Victor. I'm not going to make the live stream, but was wanting to ask you a question. How do you decide a company is discounted enough that you will invest in it? Is it a set percentage? That's a very good question, and I'm going to answer it, very clearly. So the way that I make decisions on stocks, it really depends on the quality of the company and how much risk is involved. If it's a really small company that I'm not familiar with, maybe it's riskier because they're unknown, then I'm going to want a bigger discount. Whereas if it's let's say an Alphabet, which everybody knows Alphabet, high quality balance sheet. Well, I'm not expecting the same discount on Alphabet that I would expect, let's say, on a Coinbase. There's just very different levels of risk. So depending on the company, how much risk I'm taking on, I will want a bigger discount. So that's how I go about it. There's qualitative and then quantitative, right? Qualitative, there's a lot of decision making in it. And I just kind of took you through my train of thought, which is, start with the company that you're looking at, quality level, and that's going to kind of change your criteria a little bit, as opposed to, hey, this company has great fundamentals, but they're newer. So, hey, I'm going to want a higher return. I'm going to want more discount. I'm also going to use a higher discount rate. So hopefully that answers the question, Earthbound Misfit. And as you look at my videos, you'll probably see that when I communicate how I value a company. All right. So we've got somebody checking in. Android PC. Thanks for checking in, man. How are you? Thanks for joining the live stream. And as it is the case in every live stream, please, if there's a stock that you want to take a look at, please put it in the comments. Glad to take a look at stocks and make this an interesting episode. All right. So, and I've got another comment here. Opened up a position CTRE today. Hey, thanks, Suwat Haran. I think it's the first time that you've checked in. Thanks for checking in, and good luck with CTRE. That's a high quality REIT. I've owned it for a couple of years, and they're just a really steady as she goes company, and they pay a nice dividend. It's a really good business. If you think about what they do, they provide the real estate assets where older people can go live. These are older people that need assistance with their health care while they live somewhere. And it's a category that continues to grow because we have a big aging population. And overall, CTRE just keeps delivering. They keep operating really well. So I'm hoping that is the case for many years. I'm happy with my investment, and I hope you are as well. All right. And first time. Cool, man. I'm glad you subscribed, and I'm glad you're checking in on the live stream. I really have been enjoying the live streams because people just ask questions and we get into stocks and go a little back and forth, which is great. So keep it coming. Just if there's a stock or there's a question out there, please put it in the comments and I'll respond to it. So just a quick review of the stock market. I believe that we're in an expensive stock market. And I don't like getting into like 500 different data points that point to one conclusion or another. I don't know that anybody's going to argue all that much with me when I say I think we're in an expensive market. The reasons for it, I think is kind of a little too much of how to, learning how to make the sausage or watching the sausage be made. I think we can all agree that, we have roughly about a 50% rise from the low point in 2022, and it's been a really nice run. It is an expensive market. Having said that, I'm expecting pullbacks in 2024. We had a 5% pullback in April. I thought it was healthy, but we've gained all that back. So if we look at charts here, let's take a look at, the S&P year to date. We're just doing really well. 11% gain year to date. Excellent. Love seeing my stocks go up in value. And but we had this pullback, and that was healthy. Leading into that pullback, what was I worried about is things are too nice, things are too good. And then we had that pullback, and I'm like, all right, good. We're taking some medicine. I think it's good to have a pullback, bring down some of these prices. Well, we're at it again, right? From the very bottom of that pullback to the very top, we're up 6%, and we had a down day today. So we had a little bit of relief. So this year I'm expecting, hey, we're going to have some pullbacks. Not the end of the world. It's actually good news. When we get discounted prices for companies that we want to own, that's good news, and we can go buy them. So I'm still expecting that. And, I'm not selling every stock that I own. I'm really looking strategically, getting rid of some stocks. I did get rid of one more stock this week. I'll cover that in a few minutes. And I'll tell you the reasons why I want to have some cash is that I want to be able to act when we have these pullbacks, or I want to be able to act on opportunity. And that's why I'm going to carry some cash going forward. All right. So we've got a question from Cinematographers. Very good to see you again, man. You're a regular. Thank you so much. We could definitely look at American Airlines. He had some pretty big news today. I am curious to see what the heck's going on. I'm a big United Airlines stockholder. So let's take a look. The airline business has been booming. So I don't understand what American Airlines is concerned about, but they did have some news that their forecast, they're bringing down their forecast. So let's take a look at it, see how it affected, first American Airlines, which I think the stock was down today. We'll take a close look at it and see how it affects other airlines, including United Airlines, since yours truly has a vested interest in United Airlines. All right, so I'm going to put that one on the list. I wanted to go over a stock that I sold. So I sold Roblox, and I think I always pronounce it wrong. Some of the viewers say, dude, you're pronouncing it wrong, and I apologize. And this was a company where, my process, if you watch my videos, I really like to buy into the company, then the balance sheet, and then I want a discount. This one qualified as the company. I love the company. I think their model resembles YouTube, where you have developers developing games, and then they go on the Roblox platform. Well, their fundamentals just got worse to the point where the stock is being sold at a premium. So stock has been down. I think I lost, a healthy 20% on the position. It wasn't a big position, but I just got rid of it on Monday. I just wanted it off my portfolio. It was too much of a distraction, and it was really violating my own kind of investing criteria. That was the only violator. And I knew that going in, because I'm like, hey, I just love the company. So lesson learned, I shouldn't do that all that often. If I like Roblox, just go on their website and play their games and be a fan that way. If the fundamentals aren't there, the fundamentals aren't there, and just move on. So that was a little bit of medicine that I took this week. And the stocks that I'm buying, I'll save that for later. And let's get into American Airlines, and then we'll jump into Hewlett Packard. All right. So on American Airlines, so they cut their revenue forecast. That's what they decided to do. And when we look at, let's see what the news was. What was the big drop? So the stock dropped 13%, and second quarter adjusted earnings between 1 to 115. They decreased it roughly 15 cents. Actually, they decreased it. Yeah, they decreased it 15 cents on the low end, and then 30 cents on the high end. So that is a pretty good trim. Margin came down. Revenue per mile is down. Okay. So it's a healthy, reduction of guidance. Okay. That could be concerning. The stock did go down 13%. I happen to think that you look at these airlines, they're heavily discounted. American Airlines is selling at a forward PE of 4. It's just ridiculous how cheap these things are. Because when you look at, and I know this is the case for United, we had a giant pandemic which completely disrupted airlines. And now we're out of the pandemic. So you're like, all right, great. Let's move on, right? Now, before the pandemic, United Airlines was a $46 billion revenue company. Now they are a $53 billion revenue company. So they're bigger than before. Okay. I'm kind of trying to take the last year before COVID, when everything was kind of the way it was with United Airlines. So the airline's about 5% bigger, maybe 6%. Okay, great. And their cash flow. So before COVID, we had free cash flow in this stock and they produced negative cash flow. So it's a bad example, but they went from, actually, it's a good example. So in 2019, they had negative $497 million of cash flow. Now they have a positive $1.4 billion of free cash flow. So it's like, hey, that's all positive. So when we look at their stock price, before COVID, they were trading at, let's call it high 20s, low 30s. And now you can get the stock for a third that price. All right. So high level, I'm like, these airline stocks are super cheap. Let me look at another airline, which I know quite well because I own the stock. And I happen to think that United Airlines provides the best proposition for me. And I'd rather own United. United has a forward PE of 4.77. Ridiculous. And you look at their revenue, they're just growing. I'm not going to go 21 or 20 because those were just really bad years. But from 22 to 23, they've gone up really nicely. Looking at the quarterly, it's going up like 9.7% in the latest quarter. What's there not to like? They're charging more per ticket and they have more passengers flying. When we look at cash flow, the cash flow for United in 2022 is 1.4. And let me look at the trailing 12 months. Trailing 12 months, 652 million. But the long and the short of it is, in certain years, this company produces really good free cash flow. And I don't know. I don't believe this data, by the way. Sometimes this stock analysis doesn't give me precise data. I'm going to have to look at their investor page. But the long and the short of it is, airlines, I think, are really discounted. Now, that's one thing to kind of look at fundamentals. And I think the very first question of the live stream was, what kind of discount am I looking for, in a company? Well, you also have to think about the industry. Airlines are not a very popular investment. I think Warren Buffett lost money on airlines and he swore off airlines. Like, he's never going to own an airline again. So there's not a lot of investors that are interested in airlines. So that's a fact. So you're going to continue to have very discounted companies and you're going to see really strong fundamentals. Now, I think cinematographers is talking about a dividend. I think that would drive a greater value or price for airlines is if they started paying dividends. Right now, they don't, but I think that's going to change because they're really doing well. United is really profitable as well as, American. They're doing well, especially compared to just a year ago. They're doing really well. So I would just caution everybody that, hey, if you invest in airlines, don't expect that they're going to follow kind of, a natural upward trend because just not a lot of investors like airlines. All right, let me catch up on some comments. Learn with me. If you could please cover Office Depot and Home Depot. Yeah, we can cover those. I know one of the retailers did really well today. All right, Office Depot and Home Depot. Take a quick look at those. Thanks for tuning in. I think it's your first time commenting on a live stream. I appreciate it. So Blake J, wow, American is back to and below their 2020 levels. Yeah, it's pretty, again, I've owned United for a couple years and I've been surprised that the company has really grown and the stocks really hasn't done all that great. So be aware that the airline industry is not a favorite to investors. Path is down 30%. Just bought some. Yeah, let's look at Path. I think that's one of the tech companies, right? They do technology that enables people to kind of teach I'm going to call it a robot it's on a computer to kind of do repetitive tasks. So let's take a look at that one. That one might be interesting to take a look at. So what? So I kind of gave you my sense of airline stocks. So the economy, right now the economy is not growing by any, high amount, but I could tell you that the travel industry is doing really well. You look at the cruise lines, the airlines, the hotels, everybody in the travel industry is doing well. And I think because once COVID kind of took travel off the table for a lot of people for a couple of years, people came back and they were like, man, I really miss traveling with my family or my loved ones or my friends. And people are just eager to do it and are paying, up to do it. So they're paying higher hotel fees, higher airline tickets. Those experiences are really important to people. So that's where we're at with airlines. Neil, any United Airlines dibs? Yeah, I think Neil was the one. So I don't know if they're going to pay a dividend. I think they should. I think that'd really change the stock. I think it'd make it more attractive. Yeah, and so good comment here. So I think the remote working. I've noticed on the airlines that the business travel hasn't made it completely back. So it's actually one more wave of demand on airlines. Now business travelers are beginning to go back into the office, go visit clients, have in-person meetings, and all that good stuff. So I happen to think that the business travel this year is really going to show up and it's going to continue into next year. Business travel is where these airlines make more money because business travelers tend to book at the last minute, pay higher ticket fees, and their employer is paying for it. So there's not like a lot of competition. If United has open seats or American or Delta. So we'll see what happens. Aviation fuel, you can say it's a little high. You can say that, but I think I showed you the growth in revenue and they're profitable airlines. So again, I just think that investors don't like airlines. That's just a fact. So, all right. So probably a good investment if you use this, the airline. Yeah. Yep. I tried to fly United, but at the end of the day, I always go for, if I'm flying personally, just, get the best route. If I get a direct flight, I'm on it. I hate connections and I want to get there as soon as I can. All right. So let's take a look at ODP. So, all right. So ODP. So Office Depot, right? So I think we wanted to see Office Depot. Okay, so I think I'm not following this here. So ODP. Am I looking at the right stock here? It's ODP. I'm not sure I'm seeing the right stock. I thought I was going to look at Office Depot, but the other one that we wanted to look at was Home Depot. So, all right, so Home Depot, and let me look at the comment again, maybe. So ODP, yeah, Office Depot, ODP. So ODP. Yeah, I'm looking at this one, but this doesn't say this is Office Depot. Oh, I guess it is. Okay. All right, let's take a look at it. So, all right, so this is a retailer, and man, retail is tough. And retail is kind of like boom or bust. It seems like some retailers make money and their stocks go up, and some retailers are just stuck in like lower levels and they never come back up. This stock, has been rising over time, which is very good. I'm sure that COVID really, shrunk their business because you didn't have a lot of people going to the office. It's gone up nicely, 80% over 5 years. Over the last year, it's down 8%. Year to date, it's down 32%. Wow, that's down. They don't pay a dividend. Their forward PE is 5.4. Looking at their revenue, see, we have declining revenue. Oof, this is not good. We have declining revenue. And retailers, they're every year, Amazon gets better, online gets better, and it's hard for these guys to compete. So just from a business perspective, I don't like the business. That's my first qualifier. I just don't love the business. Are they offering a discount on the stock? Maybe. But I've been caught in some stocks where just great discounts, but the stocks never go anywhere just because it's a business that's kind of a legacy business that doesn't have a lot going for it. And I just hang around, and kind of these bottom feeder stocks just didn't work for me. Nonetheless, let's take a look at their cash. Their cash for 2023, not a lot of cash flow, pretty decent cash flow, but it's not setting any records, probably because margins are really low. And if we look at the 220, yeah, you could probably make this company look discounted. But for me, just retail is tough. You're in a category for office where, people can get whatever they want online. And this business is going to have a tough time going forward. So that'd be I would stay away from ODP. It just wouldn't be a business that I think in 5 years, I'm going to wake up and see a stock that's doing a lot better because the business is doing a lot better. I think within 5 years, they may not exist, or they may be less relevant. Home Depot is a different animal because we have our homes, right? And our homes have to be continually improved or repaired. I had a plumbing issue about a week ago. Yours truly got under the sink and fixed the item. Went to Home Depot, got the parts, and fixed it. And that's usually my process, is try to fix it on my own. And if I can't, call the plumber or the electrician or whatever the trade is. And I was able to fix it. So just continuing to improve and repair homes, ditto. I don't know that we are having a huge boom in remodeling right now. I think people are pumping the brakes on that. I think interest rates are beginning to, have an effect there. And people did a lot of remodeling a couple of years ago, and that may have kind of like brought forward a lot of the demand. So Home Depot, I think, might be in a kind of slow growth pattern. It's a huge market cap, 323 billion for a retailer, but they are in a different category. They pay a pretty decent dividend, forward P of 20.68. It is a quality company. Over last 5 years, it's up 70%. Over the last year, it's up 12%. And year to date, it's down 5%. So maybe that's why it's catching some attention. I think part of why it's down is that revenue's coming down. You can see that, in 2020, there were 132. I think people were remodeling like crazy because they were stuck at home, and it even went up higher. But they may have pulled a lot of demand forward. And I would think that for the next couple of years, I don't think they're going to grow much. They have declining sales, and I would expect that that's going to continue. And I think that's going to weigh on investors. I don't think investors are going to love a stock that continues to have lower sales year after year. They do produce really nice cash flow, but even with this cash flow rate, in order for a company, I usually use a factor of 20, multiply the free cash flow times 20. That gets you within the realm of what the stock price ought to be. If I multiplied 18 times 20, I get to 320, which is roughly around their market cap. But that's for a growing company. And this company is not growing. It's a great brand. I love the brand, but it's not growing. So if it's not growing, then I got to bring that down and say, well, you got to start growing before I can value a company like this with the same rate that I would value, let's say, Alphabet or another growing company. So Home Depot, I don't know that it's definitely not an investment I would make, because I don't know that this one's going to return a really nice appreciation to the stock for a while. I think they're going to continue to struggle with the top line revenue because they have a lot of factors, pushing against them. One of them, I think the biggest one is, for the last couple of years, people have just remodeled everything in their home. They got nothing else to remodel. So what are they going to spend their money on at Home Depot? They might go to the garden center and buy some plants and so forth. But I don't think they're going to pay big bucks at Home Depot for a long time. All right, so let's take a look at. All right, so I got your comments there. S Travels, hang in there with me. I'm going to cover Path, and then I'm going to get to your comments. So let's take a look at Path. I think these guys IPO'd recently, and they IPO'd, I guess, in the middle of 2022. And most IPOs kind of follow this pattern. No matter what the company, like Airbnb is really high quality company now, but they IPO'd really high and then it dropped, and then it kind of stabilized and it went up. And you can see that with a variety of companies. And here is another one that IPO'd roughly, let's call it 2 years ago. And the stock, boy, man, they're going to change the world. And they traded as high as $80 a share. And now it's down to 18. So I don't think I've ever bought an IPO price, because most of the time this is what happens. And oftentimes at the very beginning of an IPO, you don't get very good financials. It's kind of like just a bunch of projections and so forth. I like to have a couple of quarters past, the IPO before I start getting good data. And then we really start seeing what the business is about maybe a year after. So in this case here, investors have really taken a haircut if they were there with the IPO. The company has a forward P of 35. I think this is a growing company. This is a growth company. Very good. Quarterly continues to grow. Yeah, very good growth. So growth is good. Now, are they profitable? Not quite, but you see how their losses are coming down. So they're going to hit profitability at some point. Their cash flow, when we look at their cash flow, they do cash flow. Oh, very interesting. 291, and they're growing really fast. So 291. Yeah, this one, this one's interesting. And I think these guys, so they do automation platform, right? So they have robotic processes that, if you have repetitive tasks, then you can kind of train this little robot on your computer to do these tasks. Sounds pretty interesting. Sounds like AI. So why aren't people like freaking out about this company and making it go like NVIDIA? I don't know. But their growth is really good. It looks like the price has really come down. This one, I would like to take a closer look at it and do a full analysis of it. I'm not going to do it on the live stream because I'm not ready to do it. But this one does look interesting. Analysts are saying it's discounted by 47%. Their projections are that the company earnings per share, let's take a look at that. So it's supposed to be profitable this year. Very good. And then the profits are going to grow. So again, they just IPO'd 2 years ago, and they're already a profitable free cash generating company that's in AI, that is a technology company with some intellectual property that makes them different. I like the company. I like the fact that they produce free cash flow. Now let's see in the balance sheet and see if there's enough cash on the balance sheet to be comfortable around. 1.8 billion in cash and cash equivalents. Long-term debt 58 nothing, and none. And so they really don't have any debt, and they have a good amount of cash. So I'm liking what I'm seeing here and in Path. So I'm going to put that on my homework list and evaluate that further. Thanks for the suggestion. My opinion on Path is like, hey, that's worth looking into. It looks pretty good. I like that the prices really come down. Meanwhile, they've been growing their business. They've been, develop or operating with better fundamentals so that they value much, much higher. All right, so let's get to a patient viewer. S Travels 4K. Thanks for tuning in. I think it's the first time you ask a question. Appreciate you joining. Your thoughts on AMD. And then you've got Uber, DUOL, and LBTYA. We're going to look at AMD first, and then we'll hit the next ones on the list. So let me write these down. Uber, and then LBTYA. And DUOL. Okay. So we'll hit those. It's going to be a little bit of a quick process through that, but we'll take a look at them. So, yeah. So, Sawat, you went into Office Depot, and, I don't go there anymore. I mean, it's not like it's interesting to go shop there. There's paper pens and binders and printers, and it's like you can get a lot of that stuff online and just have it delivered. And the online service levels are getting so darn good, man. It's just really tough for them to compete. Victor, recently found your channel. What do you think about EPR, BIP, looking for good dividend stocks? Well, let's take a look at those. And that is EPR and BIP. Thanks so much for joining the live stream. Good to have you. We'll take a look at those. Look at Pat's stock-based compensation. I have an opinion on stock-based compensation, and it's probably different than what a lot of people feel. A lot of people feel that stock-based compensation is a big evil thing. And I would agree that it's an expense and you're liquidating the shares for a company. I get that. But think about this, that if you make really important employees part owners in a business, and this is a technology company where they have really valuable developers, really brilliant people, and you make them part owners, yeah, they're going to work 12 to 14 hours a day. They're going to work 6-7 days a week. They're going to drive the success of your company. You're looking at Elon Musk, right? He's Tesla he wasn't the founder, but he's the CEO. And he's asking for like 50 some odd $1 billion benefit or compensation plan. That's a giant amount of money. So I don't agree with that, but I do agree with giving stock to the employees. You make them part owners, they're going to be, working their butts off to try to make this business work. Because if they're working, their tails off and they get all this stock and they're not working really hard and the stock plummets and it's worthless, they just spent 2, 3, 4, 5 years with a company, and it was somewhat of a lost opportunity. A lot of the stock-based compensation, it doesn't vest immediately. They have to stay there like 4 years or so. And you really keep them there to help you drive the success of a company. So it might be a different way of looking at stock-based compensation. I wouldn't have a problem with Path giving stock to the more important employees. And again, it's just my opinion. A lot of people feel otherwise. Matagonia. Hi, Victor. I've just joined the stream. Not sure if you covered Salesforce. If not, can you look at this? Earnings just released and down 17% after hours. Oh, man, let's take a look. So I think their symbol is CRM, if I remember right. So let's take a look at CRM. Yeah, glad to look at it. Thanks for bringing that up. I didn't notice that. I've been super busy today. And Neil agreeing with me. Thanks for joining, Neil. You're a regular. I appreciate you very much. All right, so we're gonna go. Let's go take a look at AMD. So we were talking about airlines where they don't get any love, and then we're going to talk about AMD in the AI space where they're getting too much love. And if you look at the annual return, 35%, that isn't breaking any records. 14% up. What's happened? Like from their high, they really came back down. I'm a little surprised. I thought this one would be flying up there like NVIDIA. Okay, so what happened? Why are these guys not going parabolic like our friends over at NVIDIA? So market cap's 266, call it 267. And then the revenue is 22.8. So you're paying about 13 times sales. Okay, no big deal. Forward P is 39. That's not a big deal as long as they're growing. And this is where it's not making sense. But look at this growth in 2020 and 2021, 2022, just phenomenal growth. And then boom, hit the wall. We look at the latest quarter, slight growth. If you compare the quarter that ended March 30th compared to the same quarter that ended a year prior. So the growth, I think, is the problem. And this is one of the things that I'm observing about semiconductor companies and this whole AI momentum is a lot of companies, NVIDIA is putting up numbers that are pretty impressive. I still think NVIDIA is overpriced. But when companies like AMD, Broadcom, Dell, and others are kind of getting pulled, up because the AI hype, that's where it kind of becomes, a losing proposition for me as an investor. So I'd want to know what happened with growth. Why are they not growing? And now, one thing that, the semiconductor industry is cyclical. You have a couple good years, then you have a down year or two. And if you look at TSM, they're definitely following that pattern. If you look at TSM's business, phenomenal business, but they have boom periods and then they have bust periods. So AMD, I think, is going through one of those cycles. I'd have to figure out, are they going to be improving their sales? The company that I started buying into in semiconductor, I've made money on semiconductor over the last 2 years. I didn't own NVIDIA, but I bought a stock that really did well last year in Broadcom. I bought it, sold it, made a very good gain. And then I switched horses and I switched over to Qualcomm. Now, I might be a little late to join the Qualcomm party, but Qualcomm's been doing really well. And I bought Qualcomm because I thought it was kind of being left behind the whole AI hype, and they were. And they're doing really well. So Qualcomm really, they had a bad year, but if you look at their growth, they're beginning to grow, and their forecast is that they're going to really do well. Qualcomm's tied to the smartphone market quite well because they put a lot of their chips inside the iPhone, and they're in other sectors that are going to start doing well. So Qualcomm was kind of a good investment. After I got out of Broadcom, I got into Qualcomm. I'm just sitting on my Qualcomm stock because it's just run up too much, and it's not a really good idea to kind of chase a stock upward. So I'm just sitting on a nice gain. At some point, if it keeps going up, I'm probably going to sell this one too. But if it just kind of settles down, I'm good with it. It pays a decent dividend as well. So AMD, I'm not sold on it. I think it is a stock that's worth kind of keeping an eye on because it's a company that's done really well. Their growth was phenomenal. I forgot to look at their free cash flow. So let's take a look at that really quick. So their free cash flow stinks. And this is what I remember about AMD. Their free cash flow is terrible. This is like for a semiconductor company, that's terrible. If you look at Broadcom, it's huge free cash flow. So here's Broadcom cash flow. Look at these cash flow numbers. Phenomenal, right? This company has been doing great. Look at the 1 year, 75%. Their their valuation's up to $644 billion for a fabless semiconductor company. And so that's why this company's really gone up, is that free cash flows there, and they're not growing that much. You look at their growth in 2023, 7.88%. Their latest quarter looked very good. So the company's really rocking. I took the ride on Broadcom. I bought them around this period of time. It really rocketed up, and I was happy to own the stock and made some money on it. So that's AMD. Uber. Let's take a look at Uber. I love Uber. That's another one that I've got a man crush on, a stock that I just really love. And the reason for it is that I think Uber most definitely is the best company in this category. And I think their platform has become their competitive advantage. Nobody can do ride sharing like Uber. They have the biggest network, the most drivers. Whenever I travel, and hell, when I'm in town, I use Uber. It's so convenient. And they're beginning to make money, and they're beginning to generate a lot of free cash. The company has a market cap of 135 billion to buy the number one company in their category. These guys cannot be replaced. They already are so integrated into so many things. It's a really impressive company. Forward P of 39, strong buy from analysts, discounted by 25%. I think they are not discounted by 25%, and I'll show you my valuation. But this is the leader of the pack. Now, the problem with this stock is that, it's kind of hard to buy it because it's up 75% over the last year. It has been coming down. That's interesting. Maybe it is a good time to start looking at it over the 5 years. Look at this. Look at this. So as a value investor, I love seeing graphs like these because it shows you, if you do your homework, these stocks will come down to great price levels. And you can start buying into these great companies at a price that you want to pay, and then watch that stock go up. So Uber, a couple highlights is I believe they produce free cash flow. Look at that, $3.3 billion. Go Uber. This is a newer business. And you think about it, they don't have to buy any cars. Their drivers buy the cars. Their drivers maintain the cars. Their drivers replenish and refresh those cars. They don't have to hire many employees. Their drivers are independent contractors. It's just a very good model for a company to A, provide a service that a lot of customers want, and B, really be profitable in doing so. So I really like the Uber business. I'm totally bought into their business. If you haven't noticed, I love their balance sheet. Their balance sheet's solid. You got $7.7 billion of cash on the balance sheet. Debt, current debt, 190, long-term debt, 11 billion. So they could pay a good portion of that debt with cash, and then they have really solid EBITDA. So their debt to EBITDA is well below 3, which is one of the qualifiers I have. So that looks really good. When I look at Uber in my valuation, and I need to update the stock price. I'm not sure what the stock price was. So it's 64.93. So 64.93. And I have like a 7% discount on the stock. I blend free cash flow valuation with earnings per share valuation. So it's not like a great, like, oh man, I'm going to make 50% on Uber situation. Because the stock's already run up so much. Now, if their fundamentals change and all of a sudden growth starts hitting like, mid 20s, look out. I think this stock's really going to take off. But over a long period of time, these guys are just going to keep getting bigger because their expansion into food delivery is really got a lot of addressable market to take over. And internationally, Uber is a really well-recognized brand, and they're going to continue to grow internationally. So Uber, I really like Uber, and that's my evaluation of Uber. So let's take a look at this stock. I've never heard of it. LBTYA. Liberty Global. So they provide broadband internet, video, fixed line telephony. Okay, so they're a communications company. They're a telco company, pretty big size. They got 9,800 employees. Interesting. Okay. Now, $6 billion market cap. You're getting the company for one-time revenue. Net income doesn't look good. Forward P is a little bit high. It's got a buy rating with 58. Now, my first question, I'm going to go straight to why I don't buy Verizon or AT&T, and that's debt level. Where's the debt level of these guys? So long-term debt, 16.6 billion plus 800 million. So we got $17.4 billion of debt. You guys with me? So, and if we go to their EBITDA, debt to EBITDA, 30.3. So this balance sheet I would run away from. I buy stocks to make money. I don't buy stocks to have a pile of problems. And that's why I don't buy into AT&T, Verizon, and it seems like Liberty is in that category. So the things that communications companies offer is typically they have great, cash flows from operations because people are buying, broadband. There's kind of a fixed investment that these companies have to put in. But man, the debt levels that these companies have found themselves with, they're just really risky. And I would not touch Liberty with a 20-foot pole. But thanks for asking on that one. DUOL. Duolingo incorporates mobile learning platform. Okay. So these guys do learning languages. I own Chegg. I continue to own it, and I've lost money on Chegg. Not a big position. This one, out of the gate, AI could disrupt this company. That's real. Do people really want to learn the language? Now, I would agree that AI isn't going to do everything. It's not going to teach you a language. It's not going to give you like courses that get you from not knowing a language to having the ability to maybe travel to another country and having coherent conversations. But it's still a reality that a lot of, if anything, the perception that AI is going to replace these companies is out there. This company's 8.4 billion revenue, 8.4 billion in market cap. Revenue is a little low. I expected it to be a little higher. And then forward P 124. Interesting. Okay. Now it's discounted according to analysts by about 25%. When we look at their financials, they have very good growth. Man, phenomenal growth. These guys are really growing. They're really small. So I would say they're really small, but their customers like the product because they keep buying more of it. So that's really good. Cash equivalents, 832. Debt, not a problem because they got $54 million of debt. They got plenty of cash to pay that off if needed. And they produce free cash flow. So this one looks pretty interesting. Now, the one thing that, I continue to say is I'm a Chegg owner and Chegg produces free cash flow. It's got, I think, a pretty interesting proposition. And I'm sitting on a pretty good loss on a small position, but it's still a loss. And I would just be realistic about how long, one would need to stay in a stock like Duolingo before it really comes around, because it's always going to have that headwind of AI. What's AI going to do? And applications that are going to do this type of language translation and help people to learn, those are probably like 2 to 4 years away. So it's going to be like 2 to 4 years of just being a constant threat with ChatGPT and Gemini from Alphabet. So I think the fundamentals for this company look great. It is a smaller company. It's a very small company, but their growth is phenomenal. I mean, look at this growth, 43%, 47%. That's impressive. So customers really like it. It'd be, what kind of conviction do you have behind this company? Are you willing to sit in this stock for a long time? Because it may take a while for the market to realize that this is a really good company. It's not a bad chart that we're seeing. It's up 31% in the last year. That's not bad at all. And it's had a really nice drop recently. So that is an interesting stock. I don't have an appetite for taking on another learning stock. I think Chegg, I'm good with Chegg, and I'm going to wait for the environment around AI to get more defined around what really is AI going to be able to do and how is it going to disrupt and maybe not disrupt other industries like the learning industry. Good one. I'm glad you brought it up. I appreciate it. That was a really interesting little company. All right. So we're going to look at, let let me catch up on some comments here, and then we'll keep rolling. So EQ and R, not familiar with that. And we'll take a look at that. What's up, Bad Omen? Good to see you. So, did you look at CVS in the stream yet? No, we haven't looked at CVS. I've got some quick comments on CVS I can share later. CVS has just kind of been going down over time, which has been interesting, but I'll provide the full comments later. I buy XOXQ. Yeah, so you buy an ETF. I get it. That's one way to play the semiconductor space, and that probably was a really wise move. Looking back 2 years ago, because we would have probably had some Nvidia in there, some Broadcom in there. It would have probably done quite well for you. So that was a pretty good move, Quags. Cinematographers, Uber, I agree. Minimal overhead. Yeah. So I love those business models. It's no giant surprise that Alphabet has these business models like YouTube that we're on right now. They're not paying me anything, and I'm using my own equipment to do this deal. And you guys are tuning in from wherever you guys are at. And at the same time, YouTube's making money. Well, that's the model that Alphabet loves. Well, that's the model that Uber has in a way for ride sharing and food delivery. All right. So if you have time, cover Abbott. Yeah, glad to. That's a good one. And then Lab Holding. All right. Take a look at that one. Good to have you, Learn. Yeah, you're welcome. Anderson, you're welcome. Thanks for tuning in. Duolingo. Yeah, so AI ChatGPT. So who's replacing who in this statement? I would think that ChatGPT is going to be a threat because it seems like everybody's crazy about that, crazy excited about it. All right. So yeah, thanks S Travels for tuning in. Really appreciate you asking questions. So I think, you bring up a good topic around AI. I think people are expecting that, hey, we're going to go full blast into the AI era. And I would say that, for some things where it's not really causing any harm, I would agree. Like the things that ChatGPT is doing and Gemini on the Alphabet side, where you go in, you ask questions, and maybe you ask it to write a summary, no harm, no foul. That's fine. But if you're going into a medical office and your doctor is kind of using AI to either aggregate information or make a decision, I think people would be really uncomfortable with that. I would be very uncomfortable with that. It's like, dude, don't you know your occupation? And you should be listening to me as a patient. We should be taking, whatever symptoms I have into the process. That's just one example. You can go through each industry. So what are lawmakers going to do? Well, I think lawmakers are going to eventually have to have some type of, guidelines and some types of limitations. The other thing that I think about AI is AI, you build these large language models, and there was a kind of a high profile story with an actress, or I guess they're all called actors, whether they're girls or boys. And she claimed that ChatGPT stole her voice, and it sounded just like her, but they assured everybody, no, we didn't steal her voice. It just kind of sounds like her. And they took that voice down. And as a result, now that's going to continue to be the case, because if let's just kind of, I think everybody knows what Mickey Mouse looks like. If ChatGPT or, Alphabet start creating images that kind of look like a Mickey Mouse, but they swear that, hey, we didn't create it using large language models that looked at the Disney images, I don't think anybody's going to believe them. If it looks like Mickey Mouse and your AI created it, you owe Disney all the, damages that they're going to claim. And anybody who used the app could potentially be liable. So if you're like, let's say Toyota, totally making this up, used ChatGPT to create an image, it had Mickey Mouse in it, they published it without the right and consent from Disney, Toyota would be entangled in this issue. So how fast are businesses going to take on AI? Well, there's a lot of things they have to think about before they just jump in. I think right now we're kind of playing around with some AI, use cases that aren't really harming anybody, and we'll see how far it goes. We'll see what happens. All right. So S Travels. So Nancy Pelosi has a big bet on FRGE, and Nancy's husband is this big investor, right? He's like a hedge fund manager. He's like a big investor. Take a look at that one. Okay, so let's get some likes. Yeah, thanks, man. I appreciate the support. I really enjoy doing this. I'm trying to keep up with all the good suggestions you guys have on companies. I appreciate the comment very much. And then Pan W. What's interesting about lawmakers, right, is they are allowed to do insider trading, which is funny. And it's not fair, but they're lawmakers and they're pretty much exempt to, they could be reviewing legislation that says, hey, we're going to approve the legalization of this particular thing that was illegal 2 days ago. And they could buy the stock knowing, hey, we're going to approve it. And boom, it's a windfall for them. And they have there's no issue in them doing that. I don't think that's right, but it's the law. And I love living in the United States of America. And hopefully they change that someday, because I don't think it's cool. All right. So we're going to go over, hopefully I have them in the right order. EPR. So EPR Properties, leading diversified experiential net lease real estate. So this is a REIT, really nice dividend, and market cap of $3 billion. What are they into here? So experiential properties. So this is like people go vacation and they stay there, right? Yeah. Recreation experience. Very interesting. Okay. Not a lot of employees. That's fine. Financials. They're growing slowed down a bit. Okay. And we're not going to look at the balance sheet because REITs carry a lot of debt. And if you look at it, you're like, if anything, I think it's fine if they carry a lot of debt because they own these real estate assets, which are worth a lot of money. All right. So cash flow wise, they probably have enough cash. These REITs produce a lot of cash. So what you want to compare is, this looks pretty good. The dividend looks a little high. What's the stock been doing? It's been going down. The dividend looks a little high. And you got to look at funds from operations, FFO, and you got to compare it to, see, this is going to take the typical way that payout ratios are looked at, which is earnings per share. And then you try to see if they have enough earnings to pay for the dividend. But you actually have to look at funds from operations to see if the dividend payout is reasonable. That would be some homework for whoever's interested in the stock, is make sure that the payout ratio based on funds from operations is solid. And then if you like the business, I've done Vici on my channel. Vici's a really good quality REIT. They do casino properties, gaming properties. I would say somewhat like EPR. I really like Vici, solid company. And I think people, like I said earlier, the travel industry is doing really well. People really want to get out and have fun. So let's take a look at BIP. Brookfield Infrastructure Partners. Utilities, transport, midstream, data businesses in North, South America. Wow. Okay. So these guys are into power, natural gas. Okay. That space is pretty popular, but these guys, their stock's down. Interesting. Okay. Revenues almost 13 billion. Sorry. Market cap's almost 13 billion. Revenues almost 19 billion. Very good dividend. They're growing. Okay, that looks good. So this one looks interesting. I'm not going to look at cash flow because it's a REIT. Wow. Payout ratio, 522%. So you got to look at funds from operations. And this one would be worth kind of looking at. What kind of assets do they have? Look at this growth. Very nice. So the growth rate on this one looks great. I would just want to make sure that they could afford the dividend that they're paying. Make sure there isn't going to be a big cash crunch. I don't value REITs based on free cash flows because it just doesn't get you the right valuation. I would do some homework on it, but it does look interesting. It's worth digging into and seeing what you think it's worth. I'm writing it down. I'm going to research it further after the live stream. All right, so I think we're up to CRM, and I think there was some news around CRM. Salesforce down 16%. Holy smokes. Stock's been doing okay for the 1 year. It's going to be down for year to date. If it goes down 16% tomorrow, it's going to be down, I don't know, 12, 13%. And let's see here. So this is a big cap, 263 billion. When we look at their revenue, they have been growing. Now, CRM, this company has grown over time, but they just keep acquiring businesses. And I happen to think that organic growth is kind of like the best kind of growth. If you're growing through acquisition, it's kind of cheating a little bit, but it's a good company. A lot of people like it. They produce really good cash flow. If I recall, they do. They produce good cash flow. That's fine. 9.5 billion. But I don't think I can get to this valuation with their cash flow. And it sounds like investors did not like their growth rate and probably their forecast, which is that, businesses are beginning to be fatigued on the amount they pay for software, especially if they see their headcount going down. Then we'll see how they do, because Salesforce, their primary business is they do, software for the sales force of a company, service centers, and so forth. Now you think about AI. And people are like, yeah, we got however many people. We got 10,000 people in a call center to take phone calls and help customers. But with AI, we're going to be able to trim that down to 2,000. And then AI is going to do the rest. Well, that's bad news for Salesforce. They just lost 8,000 seats of software that they could have sold to that customer. So I think there is some pretty significant risk out there to Salesforce for a long-term, from a long-term perspective. But we'll see. I think it's an interesting stock to dig into. I tell you that, like on Adobe is a stock that also has had like really jagged like sell-offs. You've had these jagged sell-offs. I've made money on Adobe. When it had these sell-offs, I would buy and I've made money on it. I've recently started buying Adobe again, and I think that they're growing well. They're a profitable company. These guys do have an AI story, and I like Adobe. It's not like a home run kind of stock. I think it's maybe if I make 30-40%, I'd be super happy. And but it's a really well-known company. It's a high-quality company. It's one of the bigger caps, and we'll see how things get sorted out with CRM. And I think CRM and Adobe compete in some marketplaces, by the way. So quick note on CVS. CVS has great fundamentals, but for some reason, the market has not liked healthcare, and they have really disliked our friends over at CVS. Look at this drop. Wow. Let me put it on this chart because it helps me take a look at it and show you a percentage. So if we look at this drop, which started April 1st, they're down 32% in 2 months? Wow, that's a drop. Meanwhile, they're paying a pretty good dividend. They generate a lot of cash. They're profitable. I think they have a pretty good business model. And I'm an owner of CVS. I'm not betting the farm on it, but I continue to buy shares. All right, so next one is EQNR. Never heard of it. EQNR. Oh yeah, I have heard of it. I did a YouTube video on this, but it's been maybe a year and a half. This is a company, I believe they're headquartered in Europe. And what's that country they're headquartered in? They're Norway. And I was surprised how much oil Norway has. And this is the company that operates in Norway. It's a good company. They pay a nice dividend, profitable, free cash flow. I own Chevron. I own a big position in Chevron. So to have a second oil company is not a good idea for me, but I like Equinor. I thought they were a pretty good company when I looked at them a while back. And there's a video on my channel covering it. It's just a little aged. All right. LH, I think LH, I'm trying to remember what they, so LabCorp Holdings. Now these guys do the lab work that when a patient, gets asked by their doctor, hey, go get your blood work and so forth. I believe that's what they do. And so they're in healthcare. It's down 9% over 1 year. What's going on with the data here? Okay, my data is terrible on this site, so let's try this one. And what's going on with this stock? Here we go. Okay, 1 year up 5%, year to date down 17%. Wow. It's got a dividend of 1.5. All right. And financials wise, the revenue went down in 21-22. They had a very high 2020. May have been that everybody had to go in and get COVID testing, and that went away, right? After COVID, it went away, and then they came back down to the business they had before. So it's not a high growth business. It's a healthcare business, but they're not growing. And they are profitable. That's good. And their cash flow is very good. So you can see how COVID really benefited these guys. They generated really high free cash flow. But before COVID, they're around a $1 billion cash flow company. And now they're, not quite as high, but pretty good cash flow. You look at their, you'd probably, if I value this company, I'd probably get close to their valuation. And this would not be a home run, kind of like, wow, I'm going to make a lot of money on this company. And one thing that I've noticed is just the healthcare space has not done what I expected it to do. And I've been waiting around for a while for my healthcare stocks to start to rally. I've been surprised because I thought they would do better. On the cash flow, so cash flow is fine. I would look at their balance sheet just to make sure their debt to EBITDA is in good shape. This one's probably going to value around their current stock price. ABT, I think that was Abbott. So Abbott, this is a pretty good cap company, 175 billion. They're down, call it flat for the year. They're down quite a bit in year to date. All right. And again, a lot of healthcare companies that are really good businesses have been like really left behind over the last year and a half, 2 years. They pay a decent dividend, and analysts say that it's discounted. So this is about a $175 billion company. They have seen a decrease in sales in 2023, and their cash flow is good, although it's come down. Looks like during the COVID years, I think these guys had one of the COVID tests, if I recall. So when people were asking for, hey, I need a COVID test, and the government was providing them for free to the citizen, they were actually getting them from Abbott, and Abbott was making a lot of money, and their revenue really went up. But now they're having a tough time growing. Their cash flow is not great compared to their market cap. This one's going to be a hard one to value. I don't think I can get to a value of 175 million, judging from their free cash flow and their balance sheet. Just to look at their cash 77.2 billion long term. Yeah, not bad on the debt. They could pay for half the debt off immediately, and they probably have pretty decent debt to EBITDA. But I don't think this one's going to value at $175 million if I put it through my model. Thanks for asking. I haven't looked at Abbott. I don't know that I ever looked at it, but I'm familiar with them, which is kind of interesting that I hadn't looked at it. So Forge Global is operates a financial services platform in California. The company's platform solutions including trading solutions. Okay, so this is like a fintech company. All right. Tiny company, 289 million market cap. It's a $74 million revenue company. They lost a lot of revenue and now they're flat. Okay. So they're really small. That makes me nervous, risky. They had a loss in revenue. Why is that? Is it that their technology didn't work? Is it that somebody else came into the market that's better? That would be, big, risk item number 2. Look at the discounts that analysts are putting on it. It's a $1.60 stock. Investors don't like looking at really small stocks. They're afraid of them. So this one's a really risky proposition. Now, this is the type of stock that's either going to go to zero or it's going to double, triple your money like really fast. But I would be staying away from a stock like this. I like making money every year. I like making a lot of money consistently. But I hate losing money on stocks like this because once it happens, it's like I should have known better. There's a lot of risk there. Now, if I knew a lot of good information around this industry and I had an information advantage, maybe, but that's not the case for me, and I'd be staying away from that stock. And then PanW, Palo Alto. These guys have been kind of in the news. So 44%. Look at this drop here. What the heck happened? Holy smokes. So that 5%. So what happened back here? Man, look at that drop. 28% in one day. Holy smokes. What happened? So I think the revenue they came in with was fine, but they probably came in and said light guidance. And if we look at their news, these guys are cybersecurity play with networking. And I think if we dig into it, here it is, disappointing guidance. And that's one thing that we've been seeing quite a bit is companies have really toned down their guidance and investors freak out. Now that freak out mode, I believe that it's just because a lot of investors believe this is an expensive market and people are afraid to be in the stock too long. They get out as soon as they can. And like this one here, bam, that big drop, I believe is because sentiment is there's fear. There's enough fear for people to want to get out of stocks like these, even though Palo Alto is in the right space. They do cybersecurity, they do networking. Those are good spaces. They've been growing. But as soon as they show some kind of sign of weakness, they sell off. Now, this is a $99 billion market cap. If we look at their cash flow, I don't know if I'm going to be able to get to that valuation. It's not like a super high growth company. It's not like Palo Alto is the only company doing cybersecurity and networking. No, there's 20 to 30. And the other risk that you always have is Microsoft could say, hey, you know what? We want to do cybersecurity. And next thing you know, they eliminate a bunch of these small companies or smaller players because they're like, hey, we're just going to include that in the relationship we have with our customers. That way our customers, return to Microsoft and they renew all their agreements with Microsoft. Or another big software company can kind of eliminate Palo Alto out of the equation by making software simpler. So Palo Alto, I think, is dealing with a lot right now, and we'll see where things end up for them. Although, their chart looks great over the last 5 years, I think it's probably a good homework stock to kind of look at and see, is this stock or is it offering up a really nice discount? Is it going to bounce back and kind of get back into this upward trajectory of the stock? Maybe. I'd have to look at a lot closer to form that opinion. All right. that was a little fast and furious. We covered, I don't know, 10, 15 stocks. Let me see where we are with comments. EPR. Did we cover EPR? Yeah, I think we covered it, right? Yeah. So I like this category. I think the travel space is going well. And I would do your homework on it, make sure that they can afford that dividend that they're paying. And before, you know what you're getting yourself into. Mark Knopfler, famous guitar. So which band does this Mark Knopfler play with? I am a music fan, but I've never come across that name. But thanks for the compliment. All right. So Brookfield, get over 16.45. Hold seems like a good entry. Yeah, maybe. How often do you do live streams? I'm doing live streams probably like 3 to 4 times a week, and I'm trying to mix it up a little. Like Wednesday, I think is a good day because we're right in the middle of the week. It's kind of like, we've seen what the first 2 days are doing. In this case, because we had a short week, usually we have 3 trading days down, then 2 to go. And then I do one on the weekends, and then I'm trying to do one interview with another veteran investor. So I'm trying to keep it interesting and kind of just trying to provide interesting conversation around what's going on with the market, where are there potentially some good opportunities to invest. Like the whole back and forth we're having here, it drives ideas for me. I don't know what it does for you guys, but I circled 3 companies that I'm going to do some homework on. Am I going to follow all 3? I don't know. Am I going to buy any of them? Maybe. But this kind of like brainstorming really does work for me because sometimes I get tunnel vision and I'm only looking at this industry and I get kind of captivated by the industry. But then somebody brings up an industry and I'm like, wow, you know what? Like Path, right? I hadn't looked at Path in a long time. Their stock really went down. Hey, you know what? I'm going to do some homework on that one. So the answer was 3 to 4 times a week. And the format is like this when I'm kind of doing it alone. When I'm with another investor, I try to kind of ask that investor questions. And what I'm hoping is that it kind of reveals their process so that, we could all learn from that experience that investor has. Super Adventures, thanks for sharing. Hey, thanks for attending. I appreciate it. Good evening from Germany. What's up, Vic? I am doing well. Evan, very nice to have you. And everything is good for me. And I loved my trip to Berlin. I loved being in Berlin and all the history. I loved the street art and really enjoyed riding the trains in Germany. That is the most, and I'm not a big train expert, but I thought I was so impressed with their trains. Super quiet, super comfortable, and stayed in Germany and then went over to Prague from there on their train. Really good experience. And I'd like to go back to Germany. I got like 20 spots that I want to go to in Germany. All right. At Super Adventures, Costa Coffee. Is that a stock? All right. So, yeah. Yes, sir. And a cigar. All right. Palo Alto is still too expensive. Yeah. It could be, but, some of these stocks, like I forgot which stock we were covering. And if you're just patient enough, right? If you do your homework and stocks tend, not all of them, but some stocks, they tend to like be sold off. Everybody forgets about them. The stocks, just drop. I mean, Meta is a perfect example, right? Like 2022, like there wasn't anything Meta could do that was right. Metaverse kind of blew up in their face. Zuckerberg is being criticized left and right, and their stock got down to the 80s. And I picked up some shares, not enough. That's my biggest position. And it just rocked from that point. And now it's way up there. Stocks will do that. If you follow enough of these quality companies, some of them will do that. And then it's a great opportunity to buy. All right. So Peter Thiel has some clout. Yeah, he does. He's the co-founder of PayPal. And then he's a very good investor and, really knows the tech industry. And which ones were the Pelosi stocks? FRG and I forgot which ones were the Pelosi stocks. I'm going to have to study the thread. Palo Alto. Okay. Interesting. Dire Straits. I look like the Dire Straits guitarist, man. I love the Dire Straits. I'm gonna have to like, but I've never seen like Dire Straits pictures. Um, I love my MTV. That was one of the big songs, but I love their like one album was awesome. Really, really like the Dire Straits. All right, Evan, come visit Aachen. I'd love to go, man. Man, I'd love to just spend a year in Europe, then a year in South America, and then another year in Asia. I got big plans. Thank you. What are the most important fundamental indicators? Very good question. So it's Pioteer, and thanks for joining. So if you watch any of my channels, like on when I evaluate a company, there's three pieces to it. First, and I think it's the first step is qualitative, meaning you have to form an opinion about a company. Like we've been talking about these companies, is the industry an industry you want to buy into? Do you believe in it? Do you think it's worth a lot? Or do you think it's a dying industry? Like we talked about Office Depot, right? That's a dying business. It's probably not going to go anywhere. So first it's qualitative, and then we get into fundamentals. Like on the balance sheet, the fundamental that I really focus on is debt. Debt is bad on the balance sheet. So I really focus on that fundamental. Other than that, cash flow. Cash flow is the other fundamental that is really important. Look at the top 10 most valuable companies. They all cash flow at very high levels. They all have grown their cash flows at huge rates. So it's no secret. Companies that cash flow go up in value. Companies with solid balance sheets don't get themselves into trouble. So qualitative at the beginning, do I love Uber? Absolutely. I think their business is great. They're number one in their category and all that good stuff I said earlier. And then I go through, okay, is their balance sheet in good health? Because that's a showstopper. If they have a terrible balance sheet and a great business, it's a terrible business because they're going to go out of business or they're going to struggle. And somebody else is going to take their idea and run with it. And then their cash flow. Cash flow will tell us how valuable they're going to be. Do I own Tesla today? I do not own Tesla. I've done videos on Tesla. I've been saying Tesla is overvalued for 2 years. I think I've been, proven to be a little bit right on that. I thought it was overly, when they hit their peak, I was like, wow, man, people are really just burning their money when it comes to Tesla. I love Tesla. I'm a fan of Tesla. I think they're cool. I think they're great cars. It's cool what they've done, but it's a car company. And the way they were being valued was pretty far off of reality. Yeah, so you're welcome. Thanks for the question. 2 cents on NVIDIA's current state. Okay. So I do have an opinion. So I've it's not the first time I've said this. You can watch my NVIDIA videos. I think NVIDIA is overpriced. Now, NVIDIA is experiencing, man, a 1 in 15 to 20 year event. And the last time we saw this was the dot-com bubble. Cisco and Intel, or maybe if you look back to other periods too. NVIDIA is way overpriced. It's just going to take a long time for it to settle down. And what's going to begin to form is again, I could be wrong, but I believe that once we get a year from now and their revenues begin to go down, everybody's going to head for the exits. So I'm releasing a video this weekend. I'm not going to steal the thunder from that video, but if you're really interested in NVIDIA, this weekend I'll release a video and I'll tell you exactly how I feel about NVIDIA on that video. Good stuff. So Adobe cash flow. Adobe does cash flow really well. Let me show it to you real quick. And I just updated Adobe a day ago. Adobe, the 2024 run rate that I have for them is 7.5 billion. And I expect that they're going to grow it by about 10%. I think that's realistic. And then 5% after that. Adobe is a technology company. And people that use Adobe product, they tend to be creators. It tends to be, and also they're in a couple of different markets. So they can really grow that. And if they can grow the number of customers, that's great. But they continue to increase the fees for their software. So when we look at that and we look at those growth rates, it has an intrinsic value of $268 billion because the terminal value is just so high. This is a technology company. They have really good cash, low debt. So overall, based on cash, it's a 28% discount. And this stock price may be a little high. I think it went down today. And then earnings per share is even better. It discounts by about 56%. So overall, I have about a 37% discount on Adobe, which is why I've been picking up shares. All right. So Asia is the best place to be in today's times. Europe and the rest of the Western world has too many problems and economies are rough. Man, I'd love to go to Asia. NVIDIA feels like 2K, 2000. You think it's going to go up to 2000? That'd be really interesting. No cap on AI future. Actually, there is, but we can reserve the argument for maybe a year's time. AI is certainly interesting, but I would ask, hey, show me 3 businesses beyond the semiconductor industry, which is the build out. Show me 3 businesses that exist today that are pure AI businesses. And let me remind you of something. Is talking to a device and getting kind of a robot to respond to you a new concept? No. Siri, Alexa, those are huge failures for 2 of the biggest companies in the marketplace. Huge failures. So they're saying, oh yeah, people are going to get really crazy around this AI engine that they talk to or maybe they interact with. Really? Well, Amazon poured a ton of money into it. Failure. Our friends at Apple, poured a bunch of money into it. Not really relevant. So what about those exercises? What leads me to believe that those are going to be like AI? Everybody's going to love it. Everybody's going to be like, oh yeah, man, I abandoned all the other apps that I use so I can use this AI app, and I'm willing to pay whomever, Microsoft or Alphabet, $100 a month for my AI. We're not even close to that. Is that 5 years from now? Maybe. I just haven't seen real AI examples where I'm like, dude, AI has really changed the game in that industry. Haven't seen it. So when I see it, I'll be like more of a believer. I lived through the .com era. I used to log into the internet, and these are beautiful screens we're looking at. We used to have these dark screens with just text. It looked like Reddit. If you guys know what Reddit looks like, that's what like the first generation of the internet, and the whole internet looked like that. And actually, it didn't look that nice. It was just all text. I know Reddit has images and stuff. None of that. We had slow internet speeds. We used to use the telephone lines to dial in and get on the internet. And early on, there was these businesses that seemed like, those businesses are probably going to work. Most of them failed. The creation of Alphabet, which, was Google before, Meta, Uber, Airbnb. I mean, I can go down a list of like 25 really valuable companies. They were born well after the internet started. It was like 10 years after the internet was going before real business models really became, formed and became really profitable. Few companies that were there at the beginning of the .com made it through. Amazon's one of them, by the way. Amazon was an early .com company. They almost went bankrupt, but they made it. But there's like a long list of companies that are irrelevant or out of business from that era. Jump into AI. everybody who thinks they can predict the future, I was there in 95, call it, or 94, 92. I was in college in those years. And I remember the applications that were made available. Some of them made sense and they went bankrupt. Some of them didn't make sense and those went bankrupt. So we'll see what we end up with on the AI side. But I'm willing to expect that it's going to resemble the dot-com era where a lot of businesses go bust. And it's going to be 5, 6, 7 years before it becomes something, if it becomes something big. So we'll see. All right. So PYUSD game changer. I'm going to take a look at that one later because I got to roll. I've been doing this for an hour and a half and I realize that I've got to get somewhere. I just want to thank everybody who's tuning in. Sorry, Jelski, but I got to roll. Hey, thank you for tuning in. Really appreciate it. And I have a comment on this one. You know what? If you made money, I would say that you weren't greedy. I didn't see NVIDIA coming. So I'm so impressed and I'm trying to learn the lessons from it. But, I made money on Broadcom. I adapted and made money on Broadcom, made money on our friends over at Qualcomm. So, there's always money to be made. And it's always, the one that got away is always going to bug us. Fifth Industrial Revolution. Yeah. Fifth Industrial Revolution. Right. Yeah. Right. So all right. So I don't have time. I'm sorry. Robinhood, I'm a believer, but the stock's really run up. I'm not familiar with Mara. Sorry about that. As travels. AI switches, hardware dependent on software. We'll see what happens there. I don't know that it's, the AI that I run on ChatGPT on my computer runs just fine, or the Gemini runs just fine on my computer. So why are they telling me that I'm going to need a new computer? I don't know why. Hey, Evan, thanks for tuning in, man. And cinematographers, thanks for tuning in. Hey, you guys are awesome. We had a great session. Thanks so much. Just to call it out, I'm going to interview a very knowledgeable investor. And I would say that he's really good financial mind on Saturday. His name's Costa. I've been watching his videos for a couple of years now. He really has a lot of great things to say. And I really encourage you to tune in on Saturday. It's going to be an interview with Costa. And I think that, again, he forces me to think a different way while he's speaking and while I engage with an investor like that. And that's always a good idea. If we just invest the same way, we're just going to be limited just to what we think we know. And if we do that for 10 years, we're just going to make the amount of money that little kind of pocket of knowledge is. But if we get somebody like Costa to talk and really open up, if anything, the possibilities, I think it's a really healthy exercise. I'm really appreciative that he agreed to do an interview. I hope you guys enjoy it, and I hope you guys can attend. All right, Bad Omen, good seeing you. Thanks so much. And see you Saturday, man. Thanks so much for tuning in, for all the comments. What's the name of his channel? Look on my channel. It's on the live streams. I have all his information on there. You can look it up. And I'm glad that you learned a lot. I had a great time. I hope you guys did as well. Good luck investing. Let's see where this market goes, and let's go make some money. Everybody, have a good night.